Joining us now with his read on the markets and yields, Chris Zaccarelli, Chief Investment Officer at Independent Advisor Alliance. Chris, great to have you with us.
Thanks for having me.
You make the point that we've definitely seen a tilt away from growth, a tilt toward value in probably most sharply in the past month, but over the past few months. Does that continue?
I think it's going to continue in the short run, but I believe by the end of the year, once we get through the midterm elections, you'll see a reversion back to growth again. The economy is really strong. Corporate earnings have been great. We're heading into the new earnings season this week. We'll see on Friday the big banks report, and then we'll really get into the belly of earnings over the next few weeks. But if earnings continue to be positive, all of the positive news that we've seen through this whole cycle continues, it should bode well for stocks. There's a lot of fears on the table right now in terms of interest rates moving higher, in terms of trade war with China. And I think the midterm elections, we haven't been talking as much about it recently, but that's definitely hanging over the market as well. Investors are waiting to see what type of investments they should make based on the outcome of these elections.
When we hear a warning like the warning that we heard out of PPG, which is soft sales in China, rising input costs, is that a canary in the coal mine? We were talking to Jim Cramer in Power Lunch yesterday, and he said, it's not a canary in the coal mine, it's a dead canary in the coal mine.
Well, from a multinational point of view, absolutely. China's a big market around the world, and that's something to worry about. But again, it all depends on your point of view. If your time horizon is very short, you may be worried in the short run. We're seeing this pullback, but I think we can work through it. And it's just a question of moving those sales around the world. It's really Europe that needs to come back to the table. Emerging markets need to stabilize. The economy can go on without China, but right now, because China is such a big part of the world economy, even if we don't have a direct exposure from the U.S., the impacts are being felt in the U.S. because it's a worldwide issue.
Does the spike in rates really speed up and catalyze a shift in investors' minds from growth to value? And is that what we've seen recently in the market moves? And just to take that a step further, which are the key sectors to focus on given that move?
Sure, that's a great question. And typically when yields spike, you see sectors like technology start to sell off. Technology is considered more of a longer duration sector in the sense that the cash flows that you're going to be getting from technology stocks are farther off into the future. You see people move towards utilities, they move towards consumer staples, companies that are paying out more of their cash flow more quickly. And so you move from this risk-off sentiment or risk-on sentiment to a risk-off sentiment. So in that environment, you typically will see people go defensive. I think you mentioned healthcare earlier in the segment, and you look at consumer staples and utilities are examples of those defensive sectors. Those may work in the short run, but as we see growth continue to accelerate, and if we can move past some of these overhangs, again, you'd want to rotate back into cyclicals. So financials are something that has not worked all year long. There's a possibility financials could do better, industrials could do better, and again, technology may reassert itself by the end of the year, but you're going to have to wait for this backup in rates to stabilize and for things to settle down before the sector rotations really die down in the market.
Chris, thanks. Chris Zaccarelli of IAA.